Okay, slowly but surely the things are getting a little bit more complicated. The following is an extract from the financial statements of Buttons Limited for the year ended 30 September 2009. And they give us a statement of comprehensive income, although they stop at net profit after tax. So again, that heading is not 100% correct. This was the statement of profit or loss. They haven't done the other comprehensive income part, which was actually applicable in this question. So please look out for headings. This heading is, technically speaking, if you have to criticize it in terms of IS1, this heading is not correct. Good, then it starts with operating profit, other operating income, profit on sale of equipment. Now guys, clearly, I cannot color in something, yeah. So it's because this is these lazy lecturers which just copy and paste. We just add in something from an Excel spreadsheet. Then we're fairly screwed. Profit on sale of equipment, 300,000. Profit on expropriation of land, 1,400. So guys, remember that is non-cash flow items. They gave it to us and we're going to use it. Here we have depreciation, 2,530,000. Loss on the scrapping of machinery, 10,000, non-cash flow. Dividend income, separately disclosable. Interest, separately disclosable, and then income tax. The statement of financial position, property, plant and equipment, investment at cost, not costs. There's an increase of 250,000, so please don't forget that. That is our silent partner. Stock, debtors, cash and cash equivalents. We have issued capital, we have reserves, we have retained earnings, we have debentures, we have other interest-bearing borrowings, we have creditors, and we have SARS. No shareholders for dividends, as far as you can see, unless they have included it in the creditors figure, and that means that if a dividend was declared for the year and there's no shareholders for dividends somewhere, either on the face under current liabilities or included in trade and other creditors, then the dividends declared was paid for the year. Further information, the company had sales of 42,345,600 for the year. Cost of sales amounts to 78% of this amount. Now maybe we're going to use it, maybe we're not going to use it. Guys, there are several ways in order to do a cash flow statement. I'm not going to show you all the difficult ways. I'm going to show you the shortest, easiest, most comprehended way of compiling the statement. I can't see why you have to do all the complicated stuff because it's not necessary. Property, plant and equipment consists of cost, machinery and equipment, and accumulated depreciation, and land and buildings. Now, it was shown at cost in 2008. Clearly, they have revalued that land and buildings in the current year because now it is revaluation / cost in the current year. And last year, there was no depreciation. This year, we have accumulated depreciation. Good. Then they tell us land and buildings was expropriated, and then there was revaluation, and there's something on machinery. And issued share capital comprises of ordinary share capital and preference share capital. And then it's a little bit more about share capital and dividends of, here they say, sorry, dividends of 151,500 were declared and paid. So there's that one figure that we need for our statement of cash flow. And here's reserves. Revaluation reserve, you can see clearly here for the first time this year, 150,000, and then there was a general reserve of R1 million. If you remember coming back here, that is the 1150 that they're carrying on all about. It actually comprised out of two items. They want from you to prepare the statement of cash flow according to the direct method with notes for the year ended 30 September 2009. Okay, so where does the direct method start? It starts with cash received from customers. So my suggestion would be that you're going to write down a fairly broad skeleton of your cash flow statement, and then as you go along, you're going to complete that with figures. Buttons Limited, statement of cash flow for the year ended 30 September 2009, 2,009 Rand, and here's our note indication. Cash flow from operating activities, cash received from customers, cash paid to suppliers and employees, net cash generated by operations, dividends received, interest received, dividends paid, interest paid, tax paid, cash flow from operating activities. And guys, once you are here, I mean, this is all standard stuff. And if you have to do the direct method, then obviously, probably, you are going to use all of these line items, so you might as well start and write them all down. Also, there is our note. So, that note is not there. Note is here. Three. It is our net cash generated by operations. That is where the note should be. Okay, so let's start then to do number one, cash received from customers. Now, if we go to our income statement, they haven't given us in the income statement, they started operating profit. But in our first bullet point, they told us that the company had sales of 42,345,600. So that is our starting point. Now we're in the additional information, there was anything about debtors. So I can just go the easy route. I'm going to take my sales figure and I'm going to adjust for accruals against my sales figure by taking the movement in my debtors into account. So that 1.5 million, that was paid in this year, hopefully. There was no credit losses, so I can assume it was paid. And that 2 million Rand from this 42 million Rand worth of sales has not yet been received by the entity. So let's start with that one. Sales, 42,345,600. There was an increase in debtors from 1.5 million, there it was, from 1.5 million to 2 million. An increase in debtors represent a cash outflow. So therefore that outflow being in brackets, I cannot stress enough, guys, if your brackets indication with cash flow statements are not correct, you will not receive a mark at all for your figure. So your bracket indication is equally important to the figure that you're going to put down. So there's our first line item, 41,845,600, and we can go and we can plot it directly into our cash flow statement, 41,845,600. Now, cash paid to suppliers and employees. Now, we know that in this calculation, we are going to work with non-cash flow items, separately disclosable items, which are these items here, and we're going to work with working capital changes, which are applicable to expenses, because this line is all about expenses converted into a cash figure. Right, so let's start then with our starting point in calculating our cash flow from operations. Now, because we're going to use such a lot of non-cash flow items, and we have identified a few when we went through the question, here in the income statement, they actually showed us quite a few: profit on the sale of equipment, expropriation of land, depreciation, loss and scrapping of machinery. We are going to use that in order to complete quite a large section of our non-cash flow items as well as our investing activities. So before we really get stuck into this cash paid to suppliers and employees, let's reconstruct our property, plant and equipment figures first. You can see in this question there's quite a lot that happened to our non-current assets. Let's start then at land. Land had an opening balance of 3.1 million and land had a closing balance of 4,240,000. So if we go here, go to land, opening balance of 3.1 million, closing balance of 4,380,000. They've told us that land was revalued this year for the first time. And clearly, when we look at this note here, the reserves note, we can see that the revaluation movement that took place was 150,000. So we can go and we can plot the revaluation of land against the debit side of our land and buildings. Then in our bullet point here, they told us that land and buildings with a cost of 570,000 was expropriated during the year. And then there was new buildings, what have you. So let's have a look at that one. Land and buildings, now we're in the past, we have written off depreciation. So you can actually, they should have said their land with a cost of 570,000 was expropriated during the year. Good. So what happens now? We have to take out that land which was expropriated 570,000 and you're going to take it to asset disposal on the land account 570,000. There was no accumulated depreciation on that land. However, in our income statement, we've made a huge profit on the expropriation of land. We made a profit of 1.4 million rand on the expropriation of land. So in our land asset disposal account, we're going to recognize that 1.4 million profit that we made. Why? In order to derive at the proceeds. Proceeds 1,970,000. Now that 1,970,000 we can go and plot directly in our statement of cash flow. Let me just get to that. Cash flow from investing activities. Proceeds from the expropriation of land, 1,970,000. Then we have parked it, we've done, and we've handled that item. Good. Then for machinery and equipment. Buildings. Before we actually go to machinery and equipment. New buildings were completed for expansion of operations and taken into use during the year. So obviously I have to account for some new buildings as well. On 1 October 2008, the land and buildings were revalued. Okay, now new buildings were completed for expansion purposes. So we have to go and balance off our land account. We have accounted for opening balance, closing balance, revaluation. We have accounted for the asset disposal. So the balancing figure on our land and buildings account is going to be our new buildings for 1.7 million rand. Now our new buildings for 1.7 million rand, that is now going to be shown under investing activities. Purchase of land, 1.7 million, and that was for expansion purposes. So expansion purposes. And I have to put down 1.7 million rand. Just coming back to our land accumulated depreciation account, we had no opening balance, but we had a closing balance there of 140,000 rand. So that means that our depreciation expense for the year was 140,000 rand. Now, if you go to your income statement, you will see there that they gave us a total depreciation amount of 2,530,000. So 140,000 of that belonged to the land. So guys, if I want to complete this picture here, I know that the total depreciation, let's add it here for you that you know that. Total depreciation was 2,530,000. Land was, as you can see there, 140,000. So it means I only have one other class of asset, and that is my machinery and equipment. So the rest must have been for machinery, which equals 2,390,000. Now you will see that probably, I don't know, maybe I need this figure somewhere, maybe I don't. But I I am able to calculate what the depreciation on land was for the year. So if they don't give me a figure, I know that I have to use this figure. Okay. Now for the machinery. The machine having a cost price and accumulated depreciation was sold during the year. The machine with a cost amounting to 810,000 was scrapped during the year. Purchase of equipment was for expansion purposes. Okay, machinery and equipment. We're going to do the cost price account. Opening balance 5.5 million, closing balance 6.3 million. Our accumulated depreciation account. Opening balance 3.5 million, closing balance 4,090,000. So there it is. Equipment at cost, opening balance, closing balance. Accumulated depreciation, opening balance, closing balance. Guys, you are totally screwed if you don't know whether it's a debit balance or a credit balance. And if you don't know this basics by now, well, then you shouldn't go on to the second year of ACCC. Good. A machine having a cost of 1.7 million rand. So we can take out the cost. And accumulated depreciation of 1 million rand was sold during the year. So we take out the 1.7 million, we take it to the asset disposal account, 1.7 million. We take out the 1 million, the accumulated depreciation on that asset, and we take it to the asset disposal account of 1 million rand. They just tells us it was sold, but we have the profit on the sale. So the profit on the sale of the equipment was 300,000. So we can put that in our asset disposal account, 300,000. So now we can work out what the proceeds was, because that is now our balancing figure. So proceeds on the sale of equipment, which we can go and plot onto our cash flow statement. Proceeds from the sale of machinery and equipment, 1 million rand, we can go and park that figure. Right. Then they also tell us that a machine with a cost amounting to 810,000 was scrapped. But they only give us the cost. They don't give us the accumulated depreciation. So we can take out the cost and you're going to have a similar type of account as the asset disposal account to account for the scrapped asset. Let's call it the asset scrapped account. So we take out the 810,000 and we're going to plot it against that 810,000. Now guys, we don't know what the accumulated depreciation was, but they've told us, again in our question, that there was a loss on the scrapping of equipment, loss on scrapping of machinery and equipment of 10,000 rand. So we can plot that into our asset scrapped account, 10,000 rand. Once we've plotted that 10,000 rand, we can now have either a proceeds on the scrapping of equipment account, or we can have accumulated depreciation, or we will be able to calculate both. Now let's go back to accumulated depreciation. In my accumulated depreciation account, we have just said that the total depreciation as per the income statement, was 2,530,000. So we have worked out here that the machinery had depreciation of 2,390,000. So let's put that there. Depreciation 2,390,000. Now we can work out the balancing figure, and the balancing figure in our accumulated depreciation account is now going to be equal to 800,000. And the only thing that can be is the accumulated depreciation on the asset which was scrapped. So if we drop down that 800,000 to our asset scrapped account, we see what, this thing is now in balance. So because this thing is now in balance, it means that there was no proceeds that we have received on the asset which was scrapped. Let's assume an asset was scrapped as a result of a fire that broke out. and we have received a certain amount from the insurance company to cover our loss. Would I have a proceeds then on the scrapping? Yes, for sure. The amount that I would have received from the insurance company would have represented the proceeds on the asset scrapped. So you cannot just assume that the balancing figure must equal the accumulated depreciation figure. You actually have to go and finish off the accumulated depreciation and see whether that account is going to be in balance in order to derive at that asset scrap account balance. And then that asset scrap, that is going to be dropped down into this account here. We have the loss, so there we know that there was no proceeds on that. If we're going to balance off our cost account of equipment, you will see then that on the debit side, we are actually going to sit with 3,310,000 additional equipment that we have purchased. So new equipment for expansion purposes, they've told us in the question it is for expansion, 3,310,000. It's not replacement, it is expansion. 3,310,000. In the question, purchase of equipment was for expansion purposes, so that is the reason why it needs to be shown as expansion. Okay, so now let's start with our cash paid to employees and suppliers. Where do we start that calculation? Guys, we start that calculation with our net profit before tax, that one there, 3,822,500. That is the starting point for that calculation. You can do it in either one or two ways. I'm going to do it this way, 3,822,500. If you want to make use of the T account, you're also welcome to do so. This is a P&L account that we're going to restructure. So we're going to start there as well with profit before tax, which will be indicated on the debit side because it is a profit, 3,822,500. Now we're going to adjust it for all non-cash flow items. Now they gave us a lot. They gave us total depreciation, which we can use as is. They gave us the profit on the sale of equipment and the profit on the expropriation of the land. We're going to use it as is. And we're going to use this loss on the scrapping of machinery as is. So we're going to add back depreciation, scrapping loss, and profit on the disposal, which is the expropriation as well as equipment. So that are those three items. So loss on the scrapping, depreciation, profit on disposal. Then we have to adjust our profit before tax figure for items which we are going to disclose separately, which was included in profit before tax. Now, those items is going to be our dividend income, 20,000, which we're going to take out of profit before tax because it increased, and we're going to take out the interest on the debentures out of the profit before tax figure as well. So dividends received, interest paid, we're going to take out on this side what interest paid. We're going to add it back. Why? Because it reduced profit before tax initially. So if we want to eliminate that, we have to increase profit before tax. And dividends received, we're going to subtract from our profit before tax. Why? Because it increased profit before tax. So if we want to take it out, we have to deduct it from profit before tax. Revenue. Revenue's got absolutely nothing to do, and that is sales, nothing to do with expenses. And in any way, we have used revenue when we actually determined what was the cash received from customers. There was the revenue figure. So that figure we also have to take out. Revenue 42345,600, 42345,600. And then our balancing figure on our illustrative P&L account, that is representative of all other expenses. And cost of sales are one of those expenses. So why do I want to work cost of sales out separately? I'm just taking a longer road to derive exactly the same answer. Because as soon as I start working with cost of sales, I will do an example later on with you so you can see what I'm talking about. But then I have to start working with inventory and creditors to see what was the actual amounts they paid between the two, etc., etc. So you're adding about 5 minutes to your calculations unnecessary. So expenses, these are all the other expenses, which was in my P&L account, which equals 37,688,100. Here I've worked out exactly the same figure. So you can see here that in total, we sit there with 37,000, that one there, 37,688,100, 37,688,100, and we're going to transfer that here, 37,688,100. It's expenses. So therefore expenses are in brackets because it represents a cash outflow. Now, we have to adjust all those expenses for the accrual principle, but we're busy with expenses. So if we go to our statement of financial position, we are going to pick up everything that's lying in the statement of financial positions that has something to do with expenses. Inventory, I buy inventory, so that is expenses. There was an increase of inventory of R1,000,000. That R1,000,000 represents a cash outflow. Why? Because I invested more in inventory. I haven't sold it as yet. My inventory levels have just increased. Then here, current liabilities, creditors. There was a decrease in creditors, and that represents also an outflow of cash because I've paid them more. I repaid more financing from creditors in the current year than what I've received. So therefore, it's an outflow of cash. So our cash paid to suppliers and employees equals 39,588,100, and I can go and plot that in my cash flow statement. Cash paid to suppliers and employees, 39,588,100. The difference between the two is our net cash generated by operations, 225,700. And I have to do the reconciliation note. The reconciliation note starts with, why does my profit before tax differs from this amount here? Because that is my cash receipts, my income converted into cash. This one is equal to expenses converted into cash. Income less expenses equals net profit. Now, why is my net profit, according to my income statement, not equal to that amount? Our net profit before tax is 3,822,500. If I converted income and expenses into cash, it is only 225,700. Why the difference? Now, guys, our reconciliation note also have a proper heading. Here, you're supposed to write notes to the financial statements. Oh, heaven's sake. For the year ended 30 September 2009. Good. Reconciliation of profit before tax with cash generated by activities. Just read the heading. Reconciliation means why are two things not the same that's supposed to be the same? That is a reconciliation. Of what two things? Number one, profit before tax. So I'm going to start with profit before tax. And then what do I want to reconcile it with? With what was it supposed to balance? It was supposed to balance with cash generated by our operating activities. The cash generated by operating activities. Good, so profit before tax, that is an easy one. They gave it to us, profit before tax 3,822,500. Now, guys, this reconciliation note is virtually, except for two differences, the same as this thing that we've done here. So the first thing that we're going to adjust it for is for non-cash flow items. Which non-cash flow items did we have? We already identified that. Depreciation, scrapping loss, and profits on the disposal, which are those two profits. 2530, 10,000, profit on the sale of equipment, and profit on the expropriation of land. Then we're going to adjust it for items disclosed separately. Here we have it. Interest paid, 15,000. Dividends received, 20,000. Dividends received, interest paid. Now, whether it's a bracket or not a bracket, I have to argue that from the profit before tax figure. What did depreciation do? It decreased profit before tax. If I want to eliminate it, I have to add it back. Loss and scrapping of machinery, it decreased profit before tax. So if I want to eliminate it, I have to add it back. A profit on the sale of any asset has actually increased profit before tax. So if I want to take it out, I have to deduct it from profit before tax. Dividends received increased profit before tax, so if I want to take it out, I have to deduct it from profit before tax. Interest paid was an expense, so it reduced profit before tax, so if I want to eliminate it, I have to add it back. Now, the only thing which I didn't work with was revenue. I have to leave revenue now. Why? Because on what line is this reconciliation? This reconciliation is based on this line, cash flow from operating activities. Now this line here, that is, oh no, not that line, sorry, this line here, that line there. That line there is after income and expenses was taken into account. So I cannot add back revenue now because revenue is added into that figure. The only thing now is when I'm going to use this as something that I've already worked out, I'm going to have increase in inventory again. I'm going to have decrease in creditors again. But I must just remember it also includes this line item. So I must have the increase in my trade debtors as well. So yeah, increase in inventory, same thing. Increase now in creditors, the same thing. And here's our debtors figure that we just have to add here, because we need that figure debtors, 500,000 as well. Why? Because we are working on this line, which includes that line where debtors and revenue has been shown. And then we add there with that figure of 2257500, which reconciles back to that figure of 2257500. Now we can show our separately disclosable items. Now we can show dividends received. We've already identified that, and there's no outstanding dividends, so the amount that was included in the income statement is also the amount that we're going to use here. It's easier to use this one. Dividends received 20,000 and interest paid 15,000. Both of them disclosable items. Dividends received is cash inflow, and interest paid is a cash outflow. Now the question told me that prior to the redemption, dividends of 151,500 were declared and paid. So we have our dividends paid figure, they gave it to us, 151,500. Tax. Let's go and calculate our tax. Right, for that we need our opening balance, our closing balance, and our tax charge for the year. Opening balance, 1 million rand. Closing balance, 1.5 million, and there's our income tax in the income statement, 1,721,000. Opening balance, 1 million. Closing balance, 1.5 million. Here's our income statement tax charge for the year, 1,721. So our balancing figure is now going to be equal to the actual tax paid for the year, 1,221,000. So tax paid, 1,221,000. Now I can add and subtract all these items from each other, and that is going to give us then cash flow from our operating activities of 890,000 rand. Great. Cash flow from investing activities. Now we have already completed quite a few of them. Here we had investment at cost, and you can clearly see this is our silent partner. They don't talk about that ever again, but you should have seen that there was an increase of 250,000. So that is that increase in investments of 250,000. Proceeds from the expropriation of land we've already completed. Purchase of land and buildings we've already completed. Proceeds from the sale of machinery we've already completed. And then our new equipment for expansion purposes we have already completed there. Now our cash flow from financing activities. Loans. Interest-bearing borrowings, that increased with 150,000 rand for the year. Our debentures have decreased with 1 million rand for the year. So increase in loans, 150,000. Redemption of debentures, 1 million rand. If you're going to have a look at the breakdown of capital, here they gave us the issued share capital. Clearly there was an increase in ordinary shares issued during the year of 300,000, and clearly there was an increase of pref share capital issued for the year of 1,450. So it's cash inflow, issue of ordinary shares, and issue of preference shares. And we can work out the net there. It's a total inflow of cash out of financing activities of 900,000 rand. Our last step is just our cash and cash equivalents. At the beginning of the year, 1.5 million. At the end of the year, 1 million. So there was a negative movement, a reduction in cash and cash resources of 500,000 for the year. If I now take my 890,000 positive, less cash outflow into investment activities of 2,290,000, plus my 900,000 cash flow from financing activities, and that must bring us back to this net outflow of cash of 500,000 rand.